Hello everyone and welcome to today's daily report market videos with me, Richard Perry, market analyst at Hantec on Wednesday 26th of June. We've had a little bit of a dollar correction in the past 24 hours, and what we've seen is this move has come on the back of some comments from Jerome Powell, the Fed chair, trying to play down the political influence potentially on short-term rates. It's obviously a nod towards Donald Trump, who's been pushing for rate cuts, but that has sort of tempered expectations a little bit and added to the fact that Powell is sort of suggesting also that the Fed will remain in wait-and-see mode, really looking at the data coming in, but also added to the fact that we had comments from the most dovish member on the FOMC, James Bullard, who played down or reined in his any sort of expectations of a 50 basis point rate cut as the first move by the Fed. That sort of helped to see the dollar rebounding a little bit. We can see that coming through on euro dollar, sterling dollar, and also dollar yen, which has bounced. You can see that through the trade weighted dollar, which actually forms a little bit of a bullish key one-day reversal, interestingly enough, after a sharp sell-off previously. Now, we've also seen the gold price falling quite sharply. 14.39 was yesterday's high. 14.10 is currently today, where we see gold sitting, although it's been slightly below there. It's about $30 back from that high. So certainly it looks as though a little bit of a corrective move is now underway. Certainly maybe the high has been seen now at 14.39. Other than that, we've also seen an interesting move from the Kiwi as well. Today the Kiwi has ticked higher. We had the RBNZ coming out with its rates decision overnight and steady on the rates at 1.5%. But interestingly enough, there was a slight dovish tilt in the language, talking about the prospect of a rate cut being needed at some stage in the future. Kiwi has bounced, but you'd question how far that Kiwi bounce can go. But certainly at the moment the momentum is with a little bit of a rebound. Equity markets off the top. S&P 500 started to consolidate in the last couple of days, but then bang, down to the move to the downside now. Again, that is alluding to the fact that Jerome Powell is maybe reining in a little bit of expectation on rate cuts from the Fed. No real move yet on Treasury yields. A little bit of a tick high, 2.01 on the 10-year, but little real recovery on Treasury yields, so I think that's worth watching, because I don't think you're going to see too much of a dollar rebound if Treasury yields don't pick up in any real fashion. But at the moment, it's interesting that we've seen gold lower, dollar rebounding, equities lower, and that is a bit of a reversal of the trend that we've seen in the last few days. So in terms of data points today, we've got the US durable goods and the oil inventories. Now, US durable goods are expected to, let me go to it, expected to grow on an ex-transport basis 0.1% on the month. So a little bit of a steadying there of the durable goods. And then the oil inventories. Now, we saw the API inventories showing a surprise inventory drawdown yesterday, or larger than expected drawdown. Will we see that again reflected through the EIA oil inventories today? We saw oil jumping this morning on the back of that oil, or that on the back of that API inventories announcement yesterday, and it'll be interesting to see if the EIA continues to help fuel that rebound. So that takes me to my chart of the day, which is the Aussie yen. Now, Aussie yen is taken to be a bit of a consideration of risk appetite in the market, and you can see that wow, there's been a consistent fall away in the last couple of months on Aussie yen. Lower highs, lower lows, consistently breaking down, finding resistance at lower levels, and rallies are seen as a chance to sell. Now, it looks as though that this is again another rebound, and we're now, I think, back at another crossroads. 74.95 area was that old low, which starts the overhead supply of this old range. Now, overhead supply up towards around about 75.30, or these old lows of the range. So you'd say that that's a bit of a near-term sell zone. So this rebound is a rebound into a sell zone. However, we can see an improvement in momentum at RSI. at 44. That's the highest since late April. The MACD line is starting to edge higher, as are the stochastics. RSI, I think above 50 would be something to sit up and take notice of. But if you also look on the hourly chart, you've got this little bit of a base pattern now forming. So this could drive a bit more of a rally than we've seen previously. However, as I said, 75.30 down to 75.95, basically where we're sitting at the market at the moment, is a little sell zone. So if the market can get through that, then it starts to reopen that reaction high at 76 figure. That is your key level I'm taking on a near-term basis, because that is a lower high, or the first real lower high to take test of. Now, if you can see the Aussie yen breaking out above that, that's a recovery. But for now, I think you've got to continue to play this as a sell into strength, because of the consistent run of lower highs and lower lows, which are still intact. And subsequently, I think you've got to still play it that way. But this is an interesting crossroads for the market nonetheless. So I wish you good luck in your trading today, and I'll speak to you later.